back, and this is the home stretch, if you please, the last 29 minutes before the budget speech starts. The markets have quietly moved a little lower, not much. They put on about 0.25% weight. They've just shed that. So we are in flat terrain at this point in time. Nothing to complain at all this morning. The rupee also just about 10 pice weaker. Bonds have moved significantly lower. We noticed that yesterday itself after the chief economic advisor said there is no thrust on increasing fiscal deficit. We saw bond yields move down to 6.75. So that's about the lowest we have seen in two and a half years in terms of bond yields. So what can we expect now that we have just about 28 minutes? We have three very important people yet again joining us. Ashok Wadhwa, the Group CEO of Ambit, is with us. Raamdeo Agrawal, veteran of the markets from Motilal Oswal, is with us. And we are also going to be joined by Mahesh Nandurkar of CLSA in just a bit. Sajid Chinoy should be returning and giving us a few more points about fiscal deficit. Oh, there, Sajid is also with us. Gentlemen, thank you very much for joining us. Well, Ashok, I'm going to ask 12 plain vanilla questions because that's about all the time we have. What are your top three expectations from the budget?
Well, first, I think we should not expect any tax cuts.
Okay.
Given the current revenue scenario and the challenge that both the government and the economy face, I think expecting any tax reductions would be I think foolhardy. Having said that, thrust on manufacturing, which means trying to provide extension on some of the sunset clauses related to backward areas, manufacturing, R&D, opportunities to create more employment, certainly could be one area of focus in the budget. Second, if you can create, go back to the old regime of long-term capital gains being defined as assets, shares held for more than 3 years, and provide an exemption. I think capital markets at this point of time needs some sort of support. And I believe that government has historically liked the idea of long-term investors. And therefore, if you extend the 1 to 3 years and provide exemption only to beyond 3 years, I think it'll provide the right sort of support to the capital markets. And I think it's consistent with what government always has said. I want long-term investors in the market. And third, if there was a possibility at all to see whether banks can be encouraged to buy out loan portfolio, and I'm talking about well collateralized, well underwritten, good portfolio held by NBFCs to real estate developers. Remember, banks have long-term liquidity. I mean, there is no ALM challenge. And in many instances where NBFCs have lent to these developers, the issue is not of quality of asset. The issue is one of being able to liquidate to be able to service. NBFCs do not have long-term liability. Banks do have long-term liability. And if there's a mechanism whereby well collateralized, well underwritten, this is not passing the NBFC problem to the bank, not at all. I think enough of that has been done, and I think government has very categorically stated that banks cannot be the place to park junk, and rightly so. But if there is a mechanism for well-written, well collateralized portfolios to be bought, it will provide NBFCs the breathing space, and I believe it can be one single change which will perhaps change the mood towards NBFC and the liquidity crisis that NBFCs face today.
Ashok, good morning. The only problem with that is, you said well collateralized, but right now the real estate market is also down. So, how will you decide the fair value of that collateral, the fair market value?
Listen, if today it appears that the value is not adequate, which is why I use the word well collateralized, if the value is not adequate, then, the equity has to take a hit. One thing we have to be very careful about, I repeat, that, we don't use this mechanism as a park to move the problem from NBFC to banks, which is historically how the banks have been unfortunately used. But, if the value has gone down, then clearly equity shareholders are already incurring a loss. To acknowledge that loss, even if it's temporary at this point of time. And you can have a waterfall mechanism. You can have a mechanism where you say that I'm passing it on to you today at the revalued lower value, and should you realize more beyond what your return is, both your principal and return, we can have a waterfall arrangement whereby it comes back to the NBFC at some point of time. But just like NBFCs, just like banks are providing liquidity to other portfolio, commercial vehicle portfolio, other securitization mechanism, perhaps a regulation or some encouragement to banks to also do similar with the portfolio of real estate developers, I think would be the big one to solve.
Okay, Raamdeo, good morning. Your thoughts on this and any other sort of move you think which should happen in the budget to sort of revive the economy?
I think they should very seriously think about aggressive deregulation of banking licensing. You know, on-tap licensing, a lot of large, I think it is very clear in this crisis that NBFCs have to be, of certain size, and after that it must be necessarily given. In fact, large NBFCs, they should qualify automatically to become a bank because they don't have a dependable liability strategy. Okay. So if you create a lakh crore, 1,50,000 crores, they become a kind of a risk to the system, which is what is happening.
Yeah, but that's not a budget item, no? On tap is RBI.
Comes through, it's all policy. I'm saying today, talking about banking license, these are all RBI measures.
Exactly.
Everything to do with the BFSI is 365 days and RBI can do it. So, but then today, because this crisis of credit flow and NBFC crisis has to be addressed to. Because you have a very clear goal of $5 trillion economy by 2024-25, 12%, 12.5% compounded GDP growth you are talking about nominal terms. So these things, it's a very ambitious target to have, but if the starting itself is, kind of with a lot of confusion, your car is not in good shape. So that has to be first repaired.
Okay, so that's on the banking side, right? What about infrastructure? We were just speaking to some tax experts a while back, and they said that there is a possibility of tax-free infrastructure bonds that could be announced to boost investment in infra. Now, as we know, private sector capacity, to fund is very limited right now. So, looking to tap retail for some money into infrastructure bonds, is that a good measure? You think? Will that work?
Whatever. It is worth trying, whatever it takes to tap, because now, first thing is, I think they need to reduce the interest rate significantly from here. You cannot go on with this 3-4% real interest rate and 2-3%, 4% inflation. I think we need to seriously go down to maybe 5% bond rate or something. So I would be surprised if the bond yield doesn't slump today after the budget. Bond yield
they've already gone to 6.74.
No, nothing. I think it should go below 6 today only. And what I'm saying is
below 6.
What I'm saying is there should be a good indication of a bond yield softening.
Okay.
So there can be a huge bond rally.
The bond rally will come only if the government says I'm cutting my borrowing.
Yeah,
no?
So
now how can they cut the borrowing? They are short on taxes.
Yeah, so I don't understand the segregates that well, but bond yield must go down.
Okay.
Yeah.
Oh, well, I agree with you.
It has fallen in last 3 months.
Considerably.
So that
6.74.
During this period, government borrowing has not come down. So how the
the rate cut and global yields have helped. And yesterday the chief economic advisor's statement that there will not be an increase in fiscal deficit and that they will stick with the glide path has helped a further 10 basis point fall yesterday. So actually, if the government stuck to its deficit, that rally has already happened in the bond market. So immediately a rally, I don't know whether there can be any steps.
I think Ashok wants to make a point on that.
Yeah, as a matter of fact, going back to infra funding, if you think about where the largest capital sits and where the largest appetite sits today for investing in long-term infra assets, it's with these large pension funds and global investment, global insurance companies. And they have demonstrated huge appetite for investing in India. If you look at the amount of investment Brookfield, CPPIB and CDPQ, etc. have made, just 2 small changes actually there can make a big difference. Currently, you have a 25% cap on the amount of investment that a particular fund can invest without becoming a sponsor in a private InvIT. If the government was to raise the 25 to 49, it allows a CPPIB or a CDPQ or any of these large funds to invest in multiple private InvITs. And why not? They are very happy to invest in multiple private InvITs. Currently, they are limited to 25. That itself will release a serious amount of cap. And the other thing I would say is, today private InvITs are not allowed to borrow from the banks. They necessarily have to go out and raise from the bond market. Why? If this is seen as best-in-class investment by long-term global investors, why shouldn't our banks also be allowed to lend to them? And I think that will facilitate...
To private?
InvITs,
Okay.
private infrastructure companies.
Okay.
You know what that will do? It will create a new vehicle for investing long-term money. And remember, this is money that is 30-year money. These are not funds that want to sell or exit because they don't have to really repay money to anybody else. I would say those two changes alone would bring a lot of money to infra.
All right, Sajid Chinoy, the chief India economist at JP Morgan, also with us. He's also one of our budget editors. Sajid, what's your sense? Can there be a growth boosting pill?
Now that's going to be very hard. I mean, there's so much focus on the expenditure side, but as we've discussed before, I think there's very little room for the government to go beyond 3.4%. I think if you go to 3.5 or 3.6, that's fine. But if you go anything beyond that, I think, the bond rally we've seen in the last few weeks will quickly dissipate. And I think focus needs to turn from the expenditure side and the wish list of everybody to the revenue side, because that's where the bulk of the pressures have been. Just to get to the interim budget tax targets, gross taxes in 2019-20 have to grow by 23%. Last year they grew below 9%. To get to the GST target, GST collections have to grow by 30%. In the last 6 months, they've grown at 11%. So I'm going to be firmly focused on A, is there a revision down more realistically to what these tax targets are? And B, what are the measures to boost tax to GDP? Will there be concrete measures to tighten GST compliance? I know that's a GST council issue, but so I think that's where the focus needs to be, because even if the government budgets much higher expenditures today, if these revenues don't materialize, we'll have the old story playing out where you have to squeeze expenditures later in the year. So before we can entertain hopes of a stimulus, we first need to stabilize things on the revenue side.
Sajid, I also wanted your thoughts on what Raamdeo was just saying about interest rates, needing to come down further. We were having this debate a while back as to whether India is setting itself up for more vulnerabilities in terms of a macroeconomic imbalance, because this is a time when there is monetary loosening and fiscal purse strings are also going to be loosened. We've seen such an instance happen, way back in 2013 as well, where we did see some sort of macroeconomic imbalance. Is that something to be worried about now as well?
Yeah, no, I would not worry about any kind of global crisis at this point that India is setting itself up to. Listen, when growth is below potential, then you would expect policy to be counter-cyclical. We've seen interest rates go down. The pressures that we actually experience are more in terms of the aggregate domestic investment savings. The reason we go on to say that there's no space for a stimulus is if you add up center, states and off-balance sheet, which is public sector enterprises, total borrowing is already between 8 to 9% of GDP, and total household financial savings are also between 8 to 9% of GDP. So the concern really is that with the government using up almost all household financial savings, that is hurting monetary transmission. One of the reasons why the yield curve is still steep, credit spreads are higher, banks are unable to cut deposit rates, is because you've got this very tight investment savings mismatch. So that's the little pickle that India finds itself in, where growth is slowing, monetary is easing, but there's no fiscal space, and in a way fiscal could undo some of the benefits of monetary. But I don't worry about any kind of global financial crisis. With oil at $60 a barrel, India's current account is very well contained. FX reserves are at record highs. We don't have to worry about external threats just as yet.
Let's discuss some more market internals. Raamdeo, a sector that you've liked and you made so much money in, autos, it's now going through the bear market. Are these structural issues which can't be resolved via budget, via stimulus, or is there something which the government can do to sort of revive the sector?
I don't think it can be a budgetary measure. I mean, there should be a demand on the ground. I mean, what will budget do? I mean, by
with this talk of perhaps cutting the GST, perhaps cut down the cost angle a bit.
It's a huge demand issue. I mean, it is in last 9 months, say Maruti's last number you saw, from 175 to 111. I mean, something has to be seriously thought through. What is wrong on the ground in terms of demand? Company guys, they are clueless what is really happening. The auto shops are closing down. So
dealers are
closing down.
In that context, will it help if there's any sort of interest subvention given to MSMEs, some more farmer, maybe some incentives to farmers, because that will help them sort of make their expenses.
No, we don't need any incentives and all. One has to understand what exactly is the problem. I mean, one has to go to the bottom of the problem, why exactly this demand is getting killed for two-wheeler, three-wheeler, tractor, truck, everything. What is it? I mean, and you are getting very granular data month after month, and it's just slowing down.
You know, earlier this week, the shocking statement on slowdown came from the Jyoti Laboratories. I mean, what is the cost of their packs? If they are complaining that this has not been a very good month, he was not extremely pessimistic, but he did say that sales have been falling, you know, that kind of a thing. Now, gentlemen, you'll have to just hold on. We have another guest joining us. Similar questions, actually. Mahesh Nandurkar, the India strategist at CLSA, has just joined us. Thank you very much, Mahesh. Well, just first a blank check question. Do you expect it at all to be a landmark budget, just because it's the first of a new term where the government has come with a huge mandate?
It's first of the new term, Lata, but it's clearly the continuing government, and definitely there are a lot of expectations from the industry and from people at large, because we are going through a phase of an economic slowdown, and also we are looking at an event which which is basically happening on the credit side. But at the same time, the revenue collection trend of the government is extremely weak, and I personally believe that there is going to be a significant revision on the downside of the FY20 revenue and expenditure target. So I really don't see too much of a leeway for the government to announce something very big, because I think the balance sheet and the P&L of the government will probably not support that in my view. So I think what we would probably be looking at is the non-financial or non-monetary measures, things that do not directly impact the government's expenditure and revenue targets. I think those will be the things that we will be watching out for.
Mahesh, good morning. Can you name some? What kind of non-financial announcements?
So what I would be looking at is clearly a push on the housing side. I think that's clearly the need of the hour, because I feel that that's one segment of the economy can possibly deliver results in the near term. And when I say near term, I'm looking at the next 12-month type of a thing. Well, there are always a few other things on the policy side, and how can we boost our exports, and how can we attract a lot of manufacturing companies that are trying to diversify out of China, and how can we attract them, and so on. So those are clearly the big things which will have a much bigger longer term impact. But from a near term perspective, I think housing is where I'm expecting a few positive noises from the government.
Mahesh, hi, good morning. I'm glad you brought out housing, because that is really the key problem that we're facing right now. It's stuck because of the trust crisis that we have in the housing finance space, the NBFC space, etc. Lack of funding completely. Will the budget address this, you think?
Well, NBFC crisis, yes, but I also feel that the impact on the NBFC segment, and therefore the segment on certain real estate developers, I personally feel it's not a systemic issue. This is limited to a certain NBFCs and limited to a certain real estate developers, but not necessarily the broader credit markets or the broader housing market as well. If you look at the macro data on the credit flow to the economy as a whole, it's not really showing big sign of a slowdown at that on that side. I mean, if you look at the credit flow side, or even if you look at the industry-wide data on the housing side. So the measures that I'm expecting are more on things like whether there is going to be an increase in the tax benefit on mortgages, maybe if there is going to be some tax incentives on the rental income, if there is going to be any measures that allow banks to provide incremental credit to the real estate sector, those variety.
That will help, you think, Raamdeo?
I don't know. I mean, they are economists, they understand the aggregates. But my sense is there is a lot of fear by the from the lending side. There is a aversion to lend, And for the good borrower side, there is aversion to borrow also.
No, this, see, EMI, how much of your interest can be set off your home loan?
Yeah, of course.
If something like that is done, see, nobody's buying homes now, no?
Yeah,
Just as you were saying about cars, even the number of buyers, will this kind of personal tax tinkering, I know this is not a tax giveaway
More for second house, you know, I think
exactly.
year before,
Yeah.
they removed the tax break for the second house, that they can restore, so the aggregate demand can go up and it becomes
under construction house.
Yeah, under construction house or second house, so that a lot of people, they can do the tax planning not through any other means but by buying this mortgages.
Yeah, so I think the rollover of capital gains tax, which has now been restricted to one house, which was earlier permitted to two houses. So if I had two houses and I sold one and I bought a new one, my rollover was permitted. That was suspended by the Act 2 years ago. If they can reintroduce that, they will create the second home buying positive attitude for sure. I'd also like to believe that if there is one area where tax can play a positive motivator in terms of encouraging people to look at housing, and housing is an area where I think support would be always welcome. It's been an area that's been suffering. In some way, that's probably the cause of some of the other challenges in the economy too. I would like to believe that anything that you can do in allowing a higher EMI deduction as a tax deductible item, and as I said earlier, the rollover of the capital gains tax, I think those would certainly help people to come back to the market, and that's needed at this point in time.
Okay, well, we just have, I think, less than 6 minutes to go before we get to know what's on the finance minister's mind. And Raamdeo, you know, I think for maximum 24 hours we'll be talking about the budget, then we'll move on to earnings, downgrades, global, etc. On the earnings front, you expect more bad news to come through, because in Q1 and Q2 the expectation is that things could be worse than what it was in the previous two quarters.
Q1 for sure.
Okay.
Let's see how Q2, because you're living by the day.
Yeah.
This is a very unusual time, you know. The market always throws new challenges, surprises. I mean, this is actually, you have to, this time patience is being tested. Now, for most of the investors, because there is no return in the last 12 months or 18 months rather, I would say, and in fact a lot of mid-cap, small-cap investors actually suffered 15-20% kind of decline. So should they remain invested? What should they do? Because I don't see firework happening immediately after budget. At least that is the expectation right now. After 2 hours we can decide.
Yeah, actually earnings, that is my big worry,
So
you know, next week.
Earnings are not happening in the sense that
And in fact,
I just wanted to get my
this
wish
morning
on
we were
that.
reading that
Okay.
point that perhaps this time even the top line growth would disappoint. By the way, just keep an eye on UPL. That's a stock which is now seeing big decline. Perhaps it's had a big run up, so that's why that stock
People are taking profit in a hurry.
taking
before-
profit in a hurry and big time. Just look at that stock. It's one way downward move since opening on that
But
stock.
generally, the market is not losing its nerve or anything. It's almost static. It's only in UPL that we have seen this bit of a shaving off. But to be fair, UPL has doubled over the last 1 year.
but just 1.5% decline. What should be
No,
the
from the high point I'm saying.
That's okay. Like, don't-
I know 1.5%.
Well, not scary. Actually, market is flat, you're right, and banks are higher. But before I come to banks, Mahesh, you want to add, how are you seeing the earnings pan out in the coming quarter?
See, the earnings expectations for the market as a whole is a function of what's going to happen on the corporate banking side, because that is really the single biggest driver for the earnings growth this year and also next year. So the corporate banks and we're clearly expecting big sort of savings on the provisioning cost, and therefore many of the banks would be reporting doubling of net profit, etc. But if you keep that aside, and if you keep certain other companies which have a low base effect, certain names on the pharma side or on the telecom side, the rest of the markets is unlikely to see any big increase. So I'm expecting the earnings growth for the rest of the market to be in the range of 10 to 12%. At a Nifty level, the earnings growth will be much higher in my view, 15-18% plus, because of the corporate banking side. But outside of that, I think it's going to be more like 10-12%.
Well, thank you very much, Mahesh. We are just now about 120 seconds from the big moment. Raamdeo, what's your sense? If they announce something big in terms of bank recapitalization, or even public sector, holding company like PJ Nayak said, some such a announcement can be dhamaka enough to keep the markets going.
Let's see what is the dhamaka, because markets, permanently move on earnings, and very little government can do through the budget to give a booster to the earnings quickly. But wherever these growth constraints are there, or where the slowdown is happening, so credit flow to be smoother, or what you can do for the automobile industry. It's a very large and very healthy industry. Real estate, it's a complete private sector. There's no public sector in real estate. So that's passing through. What are the thoughts of this government? Because now we are starting a roadmap for next 5 years. So I think I'm more interested in seeing what's planned.
What is that broader direction?
Because you set the goal of $5 trillion, 375.
How do you achieve that?
How do you achieve? How are you starting, and what are the thought process?
Okay. Well, let's also just take a moment to savor the fact that it's a historic time, right? The first time a woman will be presenting the budget, a woman finance minister, that is. So we'll take a moment to savor that as well. Okay. Last question to you before we toss to the speech: make or break budget or a non-event?
I think it's a non-event. I think, as Raamdeo rightly pointed out, the most important take-home from this budget is, do we have a direction consistent with the vision set out by the Prime Minister? And if we get there, and there's a program to say how we will get to the $5 trillion over a 5-year period, I think this will be a very welcome budget.
Is Sajid with us still?
No.
Okay, well, I rolled out the same question to him. We should get there. Any guesses? From here to there, what can they announce?
Here then,
At a period of slowdown and earnings not picking up, and to growing at 8% GDP and a $5 trillion economy, what can they announce to ensure that growth comes back?
my understanding of economics is very limited. But what I understand is that what Ashokji said at the beginning, that there's no space, fiscal space is not there. So don't expect any tax cuts and all. But monetary side, there is a space. We must use it, more than use it. If there is a space for 2%, use it 4%, 3%. Use all, and then economy responds. But don't be scared of taking steps which are how many consultants you keep asking? Finally, you got to move.
Yes.
And now you have the even monetary side also well under control. In the first regime.
In terms of inflation?
No, in terms of the kind of persons who are managing it.
Okay.
So now I think we have much better kind of control.
Sure.
Okay.
The session has begun. So I think in just minutes from now, the budget 2019 will be presented. I think we can cut across?
Okay, let's do it.
Speaker, sir.